In this video, we'll explain business asset disposal relief and how it can reduce tax liabilities.
Did you know that ignoring the recent changes to UK capital gains tax could literally cost you nearly £200,000 on your business exit? Welcome to this explainer on all about business asset disposal relief and how it works in the UK. If you're an entrepreneur, a company director, or a business partner, getting your head around the mechanics of this specific tax relief is absolutely crucial. We're going to demystify the whole thing so you can protect the hard-earned capital you've spent years building.
It's a massive problem that UK entrepreneurs commonly overlook until it is way too late. Just imagine this. You've worked 15 years pouring your blood, sweat, and tears into building your business, only to hand over an extra £80,000 right at the finish line simply because you weren't prepared for the changing legislation. If you sell your business for a £1 million gain today, your maximum tax bill under the new rules could be a staggering £180,000. That is a massive jump from just a few years ago when the rate was effectively locked at 10%.
And that is exactly why Pro Tax Accountant, a premier UK accounting firm, has put together this explainer. At PTA, we help businesses navigate these shifting tax rules so they don't get caught out. Today, we are answering the most common questions we receive from clients to show you exactly how business asset disposal relief works, how to handle the current landscape, and how to maximize your business exit without falling foul of HMRC. To keep things simple, we've structured this explainer around 4 main areas: what the current rules are, who is actually eligible, the compliance steps you must take, and the really costly mistakes you absolutely have to avoid. Okay, let's dive straight into our first section, the current rules and the numbers you need to know. Business asset disposal relief, which, by the way, used to be known as entrepreneur's relief, allows you to pay a heavily reduced rate of capital gains tax on qualifying business disposals. But here's the catch. The generosity of this relief is shrinking fast, so timing really is everything. Pre-April 2025, the rate was a highly attractive 10%, but from April 2025 to April 2026, it jumped up to 14%. And culminating on the 6th of April 2026, the rate jumps again to 18%. This ticking clock means if you're currently negotiating a sale or planning to close up shop, pushing your completion past these April deadlines is going to have some massive financial consequences. You can see how these shrinking tax savings look over these 3 periods, and it paints a very clear picture. On a maximum £1 million gain, what was once a £100,000 tax bill becomes £140,000 and eventually £180,000 post-April 2026. Now, even at 18%, it still remains more favorable than the standard 24% capital gains tax rate for higher earners, but that gap is closing rapidly. It really emphasizes why you have to be proactive in your exit planning rather than leaving it to the last minute. So the crucial point here is that this £1 million limit is a strict, cumulative lifetime cap. It is absolutely not an annual allowance that just refreshes every year. So, for example, if you claim BADR on a £600,000 gain from selling your first business, you only have £400,000 of relief remaining for any future ventures in your entire lifetime. Once you exhaust that £1 million pot, every single subsequent business sale you make will be taxed at the standard higher capital gains tax rates. That means if you're a serial entrepreneur, you need to be incredibly strategic about when and how you apply this relief. You really don't want to waste your allowance on a smaller exit if you have a massive buyout on the horizon. Right, moving on to Section 2. Who does this actually affect and who is eligible? If you are selling shares, the business must meet a very strict definition of a personal company to qualify. You can't just be a passive investor who threw some money in and stepped back. You must actively hold at least 5% of the ordinary share capital and 5% of the voting rights. Critically, you also need 5% of the economic entitlement, meaning the distributable profits and the assets if the company were wound up today. On top of that, the company must actually be a trading company. For instance, if your company's main activity is just holding buy-to-let properties and collecting rent, HMRC is going to classify it as an investment vehicle, and you will not qualify for BADR. The relief is specifically designed to reward active entrepreneurship, not passive wealth accumulation. This means whether you are a sole trader selling your life's work, a partner in a firm, a company director, or even a key employee holding 5% or more of the shares, BADR can apply to you. But remember, for corporate shareholders, you must also be a genuine employee or office holder, like a director or company secretary for the business. Simply holding the shares without any employment or directorship connection will instantly disqualify you from the relief. Okay, on to Section 3. Let's talk about these specific compliance steps you need to follow. You have to meticulously follow these 3 core compliance steps to ensure HMRC doesn't just flat out reject your claim. Step 1 is the ownership test. You must have owned the business or shares and met all those 5% rules we just discussed for 2 continuous years leading up to the sale or closure. And that word continuous is absolutely vital. If your shareholding dipped to 4% for even a few weeks during that 24-month window, the clock resets entirely. Step 2 is the actual disposal, formally selling the shares, selling the business assets, or legally closing the company. And step 3 is making the formal claim, which is typically done by declaring it on your self-assessment tax return. Honestly, skipping any of these steps or doing them out of sequence can be totally fatal to your claim. Mark this deadline on your calendar, because missing a deadline with HMRC is a costly mistake you simply cannot afford. You must claim BADR on or before the first anniversary of the 31st of January following the tax year in which the disposal is made. Let's make that concrete. If you sell your business in the 2024-2025 tax year, you have until the 31st of January 2027 to claim it. Missing that date means you forfeit the relief entirely, and you'll be stuck paying standard capital gains tax rates up to 24%. Now for Section 4, which might be the most important. What dangerous pitfalls and mistakes do you need to avoid? If you are closing down a highly profitable limited company, a simple voluntary strike-off can actually become a massive trap. It might seem like the quickest, cheapest way to close a company, right? Well, if your company's retained profits are over £25,000, a strike-off means all of those distributed funds are going to be taxed as income dividends. Depending on your personal tax bracket, that could mean tax rates up to nearly 40%. To access capital treatment and get those much lower BADR rates on reserves over £25,000, initiating a formal Members Voluntary Liquidation, or MVL, is absolutely essential. Now, an MVL does involve appointing a licensed insolvency practitioner, which costs money, but the tax savings you get on a large cash reserve will vastly outweigh those professional fees. Here is a truly vital professional tip directly from the experts at PTA. A lot of business owners personally own the commercial property their company operates from. It seems smart to charge your company rent, right? Well, actually, no. Charging your business market rent turns that property from a business asset into an investment asset in the eyes of HMRC. And doing that completely destroys your BADR eligibility on that property when you eventually sell it. Structuring this correctly from day one is literally the only way to protect your relief. You also have to steer clear of the phoenixing trap. HMRC strictly enforces what they call Targeted Anti-Avoidance Rules, or TAR. Basically, if they believe you closed a business purely to extract the cash at the lower bad rate, only to turn around and start up a very similar trade within 2 years, they are going to heavily penalize you. For instance, if you close a successful IT consultancy, take the cash at a low tax rate, and then open a nearly identical IT consultancy 6 months later, you will trigger an immediate HMRC investigation. They can and will retroactively reclassify your capital distributions as income dividends, hitting you with tax rates up to 39.35%. Time for a quick "Did you know?" segment. Did you know about the spousal transfer trap? Because the BADR limit is £1 million per individual, couples often try to double their limit to $2 million by transferring shares to a spouse right before selling the company. It's a classic mistake that ruins well-intentioned family tax planning. Transferring those shares automatically resets that strict 2-year ownership clock for the receiving spouse, completely disqualifying those transferred shares from BADR entirely. All right, let's wrap this all up with a quick summary and talk about your next steps. To quickly summarize the main takeaways today, the BADR rate rises to 18% post-April 2026, but it remains incredibly valuable compared to the standard rates. You're working with a strict £1 million lifetime limit. You absolutely must meet the 2-year continuous ownership rules without any gaps whatsoever. And ultimately, because these rules are so complex, from the 5% economic tests to the traps surrounding property rent and phoenixing, proactive, professional planning really is the only way to secure a successful, tax-efficient exit. Please do remember that this explainer is for informational purposes only and doesn't constitute formal financial or legal advice. Every single business structure is unique, and getting it wrong carries severe financial penalties. For tailored, professional advice on your specific exit strategy, you really need to contact ProTax Accountant today. Give them a call at 07985-689912, drop an email to info@protaxaccountant.co.uk, or visit their website at www.protaxaccountant.co.uk. Thank you so much for joining me today, and please don't forget to subscribe to the PTA YouTube channel for more essential insights into protecting your business wealth. Before you go, I want you to ask yourself, is your current exit strategy resilient enough to survive the upcoming tax changes, or are you unwittingly leaving tens of thousands of pounds on the table?